Okay, now we're going to take a look at asset management ratios, a second category of ratios, a category that gives a little bit different picture, a little bit different story about how the firm is doing. And in this case, we're looking at how effectively or how efficiently the firm is using the assets that it has invested money in. It's taken money from outside people, from bondholders, stockholders, and it's used those funds to buy assets. So we care about, and investors in particular care about how well they're using that money, how efficiently, how effectively. So the first ratio in this category is called total asset turnover. It's defined as sales over total assets. We'll look at an example here in a minute. Fixed asset turnover is another one. Now we're looking at, instead of total assets, we're taking out the current assets and we're just looking at the long-term assets of the firm, the fixed assets. And it's net fixed assets because it's going to be net of depreciation. So we'll look at the book value of the long-term assets. Typically, we would think of that as property, plant, and equipment, PP&E, for the fixed assets. Inventory turnover is a little bit more particular asset management ratio. It's looking now at how effectively the firm is managing its inventory, how effectively it's using that current asset. And it's defined as cost of goods sold divided by the inventory number. Days inventory is kind of a sister ratio to the inventory turnover. They're both measures of inventory, how quickly the firm is going through its inventory. In this case, the days inventory gives a very kind of specific measure, and it's basically saying how many days does it take the firm on average to go through a full set of inventory at a time. So if we take 365 divided by the inventory turnover, we'll get some number of days. Let's say it's 60 days. That's saying that the firm every 60 days goes through their entire inventory. The inventory turnover, on the other hand, would say something like it would be 6. So it says that the firm would go through its inventory 6 times during the course of the year. And those would be equivalent ratios. It's kind of like 6 of one and half a dozen of the other. They're both telling you the same kind of qualitative information. And then the particular ratio for receivables, which is days sales outstanding, it's defined as the accounts receivable number divided by the sales per day. As that tells you basically how many days of sales you have not collected cash for. They're accounts receivable, so you've made a sale, you've not collected the cash, and how many days of sales are we waiting on to get the cash. So let's look at computing those numbers, calculating those numbers in Excel with the data from Home Depot. Okay, so let me go back to the comparison sheet. We've calculated the liquidity ratios for Home Depot. Now we're going to take a look at these asset management ratios, and the first one is the total asset turnover, or TATO. So I'm going to have the equal sign there, and again go to the Home Depot balance sheet. In this case I'm going to go to the Home Depot income statement, because the definition is sales divided by total assets. So I'm going to go over here to revenue. That's the same thing as sales. It's synonymous with sales. So I'm going to take that number, I'm going to divide it by total assets, which is on the balance sheet. I need to go to this cell here. And the number I get is 1.776. So that's saying that the firm sells about $1.77 for every dollar in assets that they have over the course of the year. The higher the number there, the more effectively you're using the assets of the firm. So everything else being equal, we want to have larger numbers there. But we don't want a number that is too big. You can have numbers that are too big here, and we might talk about that in class some. So I've got that number for 2006. I can just copy my formula across, and we can get a little sense of what's happening to the asset management ratio over time. And you can see from 2006 to 2009, that number steadily decreased. So the firm was a little bit less effective in managing its assets. But from 2009 going forward, the numbers got much better. And of course, from 2006 to 2009, the country was going into a recession, and obviously that affected Home Depot. With the housing market in a slump, that's going to affect their sales. So if sales go down and total assets stay basically the same, we're going to have a deteriorating total asset turnover number. But there was a significant improvement from 2009 to 2013 as the economy recovered. So the asset management has gotten better over time with this by looking at this one ratio. Now let's look at the fixed asset turnover. So with the fixed asset turnover, I'm going to again go to the income statement and get the sales number, 79,022, and I'm going to divide that by the net PP&E number. And that is the sum of this gross property, plant, and equipment number and the accumulated depreciation. So what I'm going to do is add up those two numbers. So I'm going to put sum and then add up these two cells, and I will have the net PP&E. So my number there is 3.173. If I copy those formulas over time, we get a very similar story as we had before. There was deterioration from 2006 to 2009, and then things rebounded. So you can see again that with these different ratios, we have two different looks, two different views at the company, and we get very similar stories across those two. So now let's look at inventory turnover. We're going to look at cost of goods sold divided by inventory. Cost of goods sold is an income statement item. So I'm going to go to the income statement and look at the cost of goods sold. In this case, it's called cost of revenue. And then I'll divide that by the inventory, which is a balance sheet number here. And so we've got inventory turnover of 4.6 in 2006. And over the course of the 8 years that we have here, that number stayed, well, it dipped down during the recession and has climbed back up to a little over 4.6 in the most recent year. That means, real quickly, that we're going through, Home Depot is going through its inventory about 4.5 times per year. The days inventory is just going to be the 365 divided by the number we just calculated. So that says that basically every 79 days, Home Depot is selling through its entire inventory, and that number isn't a whole lot different in the most recent year. So the days inventory ranged around 79 to 86 days over the course of that 8-year period, and we ended up in 2013 about where we started, a little over 78 days to sell through the inventory. And then finally, a little look at the accounts receivable. We're going to take the accounts receivable number, which is a balance sheet number, and the current assets. So we'll take the net receivables and divide that by sales per day. So we're going to go to the income statement. We'll have sales divided by 365, and I'm going to fix my parentheses so the calculation is correct here. And so we have 11 days of sales outstanding in terms of we're waiting to collect that money from our customers. So not a huge part of the current assets of the firm, and it's gone down over time. So receivables are not a big part of the Home Depot business. So that is the asset management ratios, the set of asset management ratios. I'm going to stop the video now, and we'll pick up in the third video with leverage ratios, which look at how the firm is using debt and how effectively the firm is using debt. So we'll pick up there in video 3.